Hi, my name's Andrew Masters and I'm an analyst at FIBO Group. In this video, we'll talk about spread and trading sessions in the foreign exchange markets. We often talk about a broker and a trader, but maybe you still don't understand the exact difference between these notions. So you're a trader, a private individual making profit from the exchange rates differences. It's only you who makes a decision whether to buy or sell those assets. The broker, the organisation implementing your decisions. Brokers make profit from the spread or commission. Brokers don't care whether the exchange rate falls or rises, as well as whether you earn or lose. The broker will make a profit in any case. So if everything is clear with the commission, then what is the spread? The spread is the difference between the purchase price and the sales price. It's like a currency exchange offices or banks. It's always more expensive to buy the currency than to sell it. Consider the following example. Euro-dollar pair. There are two prices, bid and ask price. Bid makes 106.26 and ask makes 106.28. Any purchase operation is carried out at the ask price. Any sales operation is carried out at the bid price. The spread is the difference between the ask and bid. In the case of the euro-dollar, it makes 2 points. We've already understood the basic trading principles, so let's now talk about the time frames for trading the market that works around the clock. But it's important to consider what assets you trade and what time. American and Asian sessions are the most aggressive. New Zealand and Australian sessions are the quietest ones. The largest volume of operations is made during the European session.